These smaller cap companies are making investors millions of dollars right now. I've got 8 smaller cap companies. Some are small caps, some are mid caps, but none of these companies fall in the category of large cap. All of these stocks are in a very good spot right now. They're either rising like crazy already and making investors a killing, or they're in a position where they've actually fallen a little bit recently and become even more attractive as potential buying opportunities. I'm gonna give a quick overview of each one of these stocks. I'm gonna talk about each one of these stocks' most recent earnings and whether or not, for me, if these stocks are a buy, sell, or a hold at their current position right now. I'm super excited to dive into this video, but first, if you're new here, I'm Austin. I'm a co-owner of cloudmusicsuite.com. I'm also a stock market investor, and I'm a shareholder of most of the companies on this list. I'll let you know as I go through them whether or not I currently hold shares or not. If you're not subscribed to the channel already, become one of those 5,200 or so people. We'd love to have you. And consider joining the Patreon with the link in the description and joining the other 33 patrons in there. We're building a nice community over there. We'd love to have you over there as well. Let's jump into the video. First stock up here is Hims & Hers Health. This is ticker HIMS on the market. This is a stock that is up 35% in the past 6 months, 147% year to date, and over the last 1 year, it's up 183%. This stock has been making investors very, very good money. I have thankfully been the beneficiary of that because I do own HIMS shares. This is a stock I'm still currently buying. I have not hit my share goal yet with HIMS, and I actually own this stock in 2 accounts. I own it in a tax sheltered account, and then I own it in a traditional taxable account. The stock is a mid cap with a market capitalization of $4.76 billion. In their most recent earnings report, they had revenue increasing by 77% year over year. They had net income of $75 million, adjusted EBITDA of $51 million. Their subscriber count grew all the way to 2 million. That's up 44% year over year. And they raised their full year revenue guidance very nicely, and they raised their adjusted EBITDA guidance very nicely inside of Q3. This is a company that's growing absolutely ridiculously, not only on the top line, but also on the bottom line. Check out the EPS swing from Q3 of 2023 to Q3 of 2024. -4 of EPS in Q3 of 2023. 1 year later, 32 cents of EPS in Q3 of 2024. That is a ridiculous swing in a 1 year span. They're growing like crazy. They're not just an empty revenue growth company. They're a revenue growth company with a nearly 80% gross margin, and they're growing that net margin very, very fast. And we're only in the early stages of them hitting profitability. This company is about to go absolutely nuts in terms of EPS, and we know that stocks follow earnings over the long term, and over the long term, HIMS is about to have crazy EPS growth. I would say their EPS growth is going to outstrip their revenue growth by over 2x, which is insane because as we saw, they have 77% revenue growth. So if you're outstripping that by 2x, that's over 150% EPS growth on a yearly basis. That's what I expect for HIMS. And they've got all that crazy growth while having 4x the assets in comparison to liabilities. And the valuation metrics are still looking very, very attractive. On a trailing 12-month basis, the GAAP price to earnings ratio is 52. That might sound high, but when you think about the fact that they've got 77% revenue growth and more than double that of EPS growth, that is a steal deal. Forward price to earnings ratio on a GAAP basis is only 43.45. This stock is a screaming buy. Other competitors in the healthcare space that have so much less growth, less than 1/10 of the growth of HIMS, are trading at similar price to sales numbers. Johnson & Johnson is actually at a higher price to sales ratio than HIMS. HIMS right now has a price to sales ratio of 4.06. That's lower than the legacy companies like Johnson & Johnson. If you don't know what HIMS is, they're a telehealth company that focuses on hair loss, sexual health, and fat loss now. They've got their GLP-1 injections that are going very nicely. They've been the trusted leader in the telehealth and hair loss space for quite some time now, and they've got a very nice moat around them due to the trust that they've built with their customers and the ease of access to these drugs that has really helped empower the consumer in a major way. This is the only healthcare related company that I own, and it's the only one that I'm even interested in owning at all. And there's obvious reasons as to why I'm interested in owning it, and I want to talk about real quick, is this stock a buy, a hold, or a sell right now? In my opinion, this stock is a screaming buy. I am actively purchasing shares. I bought shares on Thursday, I bought shares on Friday, I bought shares here today. I'm buying really heavy under 20, I'm buying decently between 20 and 25, and I'm buying a little bit lighter from 25 to 30. Next stock up on the list is the Honest Company. This is ticker HNST, and this is a stock that is up 90% in the past 1 month, 168% in the past 6 months, 124% year to date, and 361% in the past 1 year. This is a stock I've been talking about for quite a while now. The first time I ever made a video about it, it was at $2. The second time I made a video about it, it was somewhere around $3.50 and it was jumping up into the $4 range. Now we're at $7.25 and the stock has gone crazy. It has rewarded shareholders in a massive way because they've been able to turn around margins in a crazy way. So that's where my commentary is going to focus a lot. If you don't know what the Honest Company is, they're a baby product brand, meaning diapers and wipes, and they have beauty products. They have soaps, they have lotions, they have face serums, they have makeup, etc. The market cap on this company is very small. This will be considered a small cap company at $731 million. The new CEO, Carla Vernon, when she first got there about 1.5 years ago, I was not so hot on her. I actually wrote a letter to investor relations and I sent it in saying, when is this company going to start focusing on margins? No joke, I sent a letter to the Honest Company. I actually never got a response, which was actually kind of frustrating because I own a ridiculous amount of shares of Honest, but I sent a letter to them and I said, we're focusing on the wrong things right now. I'm not going to talk about what my frustrations were specifically, but mainly I was focused on the fact that they were not growing margins and I was getting very frustrated as a shareholder. I had a lot of belief in this company, but it was going a whole lot of nowhere. The stock touched into the $1 range, like low $1, because there was nothing going on for the company and I genuinely thought that there was a possibility the stock was going to go bankrupt. I gave them a 2-quarter span in order to prove me wrong, in order to bring the margins back around. And believe it or not, they were actually able to figure it out and they were able to deliver on those margins. And I have stayed a shareholder since then because the things I needed to see happen inside of each earnings report. The margins have gotten so much better for Honest. And I want to show you what I'm talking about here. So in their most recent earnings, they reported $99 million of revenue in the quarter, which is a 15% increase from the prior year quarter. They delivered a positive net income. And now here's the big thing that's been making the stock move massive. They expanded gross margin 710 basis points. That's 7.1%, all the way up to 39% versus a prior year quarter of 31.6%. And they raised full year revenue guidance and full year adjusted EBITDA guidance. They've been able to expand that gross margin by really keeping the operating expenses lower, keeping R&D, keeping marketing, and keeping SG&A as a percentage of revenue lower and lower each quarter while growing that revenue respectively around 15%. That's not like a crazy revenue growth company, but it's very respectable and nothing to scoff at. So I'm glad that they're able to grow that revenue and bring the expenses down at the same time as a percentage of revenue. When we have that situation going on, the margin's going to explode. As we see, it's up over 7% in a 1-year span. And that 31.6% margin they had last year, that was a great margin for them. They used to be in the high 20s, then they got into the low 30s, and then they got into the mid 30s. Now they're in the high 30% range as it relates to gross margin. I see them having the possibility of cracking past 40% gross margin, which is really respectable for a cosmetics company and a diapers and wipes company. Speaking about margins, the net income margin used to be not measurable, meaning negative, and now they have a net income margin of a very modest and very small 0.2%, but at least it's a positive net income margin now. Adjusted EBITDA margin also used to be non-measurable, meaning it was negative, and now we have a 7.1% adjusted EBITDA margin. The company raised full year 24 revenue outlook to high single-digit percentage growth on revenue, up from mid to high single-digit percentage revenue growth, and adjusted EBITDA was raised to $20 million to $22 million, up from $15 to $18 million. Very impressive and respectable raises. As long as they can raise and beat for the next many quarters and keep those margins trending in the right direction, the stock is going to keep on getting more respect from the market and more shareholders are going to want to open a position with Honest. They're in the early stages of profitability. The next step here is to get the net margin to increase. When the stock is flipping the profitability corner and they've got expanding gross margins and they've got respectable revenue growth, typically that type of stock is going to get a lot of respect from the market and it's going to get more shareholders wanting to hold that stock. Tons of investors will never even touch a company that's losing money. So just the fact that they're committing to being a net income positive company, that's a huge deal and it's going to mean big things for the stock price. As I said with Hims, Stocks follow earnings over the long term. Honest companies' earnings growth looks like it's going to be in a great spot for many years to go in the future. If that's the case, over time, the stock price should reflect that. The stock has way more revenue growth and way more margin expansion than your typical legacy cosmetics company, but the price to sales ratio is still about half of a lot of those big legacy cosmetics companies. The stock is in a very good spot. For me personally, since my position is completely built out and I've been holding the stock for a very long time and we're sitting on a crazy gain, I am personally just holding the stock. I'm not buying anymore. If I had no position with the stock, I think I would be okay with buying the company still, because I do see more upside over the near term and definitely over the long term. I think this stock could be $10 within the next 4 quarters, which would be about a 40% gain from here. A 40% gain within a 4-quarter span, a 1-year span, is very respectable and very nice. If my predictions are correct, you could still make very good money on the stock. Just make sure if you're going to be buying the stock, know that it's run up a lot recently. Maybe consider buying over a 1 to 2 month span to take advantage of any potential dips. I think with a lot of companies that have been flying high lately, there's a possibility that in January we get a big dip because people are going to be taking some of those gains off the table. They don't want to take those gains off the table in December because then have to pay taxes on that in April of 2025. But if I sell it in January, I'm not going to have to pay taxes on that until April of 2026. So that's something to consider. We might have a little bit of a sell-off in January due to the crazy gains we've seen in the back half of the year. I'm going to make a whole separate video about the potential sell-off in January, so be on the lookout for that. But honest, for me personally right now, I am just holding stock and I'm enjoying the gains. Next stock up on the list is Upwork. This is a stock that was featured in my 3 stocks I'm buying video a few months back, and it has done us pretty well since posting that video. In 1 month, we're up 44%, very impressive. 6 months, we're up 33%. Year to date, the stock is only up 2%, and then on a 1-year span, the stock is also only up about 6%. So not an amazing year, but a very strong past 1 and 3 months for Upwork. The main reason for that is that they have made it very clear to investors that they are focusing on profitability. They are doing everything they can to make sure that their EPS is going to be in a better spot each and every quarter for many quarters to go in the future. This is not a stock that's got absolutely insane growth or anything. This is not a Palantir. This is not a Tesla. This is not an Nvidia. This is a stock that's going to be a net margin story. A net margin story can still make you crazy money. You don't have to have 40, 50, 60, 70% revenue growth in order to make a great return on a stock. Upwork is already very reasonably valued at a forward PE of 23 and a trailing PE of 24. That's still a very respectable PE ratio. It's not like it's crazy overvalued right now. But if they can focus on profitability and really grow these profitability numbers, we're going to be in a crazy spot in a few quarters. In their most recent quarter, they had 10% revenue growth, which is not great, but they achieved record GAAP net income of $27.8 million and adjusted EBITDA of $43.2 million. Third quarter GAAP EPS was 20 cents per share. They raised their full year 2024 guidance for revenue and adjusted EBITDA. And very exciting, they announced a $100 million share repurchase program. The reason share repurchases are important for a company that's in the process of growing that net margin is that it's going to expand their efforts even more when we're talking about EPS. If I'm able to take shares off the table as a company by buying back shares, that's going to increase the EPS more than the net income is increasing. So whenever I do a share repurchase, sometimes the net income will be up maybe 12% or 10% or something like that. And if I have net income up 10%, but we're doing a massive share repurchase, we can actually see EPS up maybe 14 or 16 or 18% depending on the size of the repurchase that they're going for. Speaking on the management team's commitment, listen to this quote: "Through our disciplined execution, we accomplished a record high adjusted EBITDA margin of 22% in the third quarter. We are wholly committed to growing profitability and have made great progress towards achieving our 35% adjusted EBITDA margin in the next 5 years." That would be massive for Upwork. And it sounds like they're going to do everything in their power to make sure that they hit those goals. And one of those things, although it's a little bit sad, is they did a mass layoff. They laid off about 20% of their workforce. That's going to help their profitability as well in a massive way. And definitely give them the opportunity to increase their net margin in a massive way over the next few years. It's already going crazy. Net income reached an all-time high, like we said, of $27.8 million in the third quarter. That's up 70% in comparison to net income of $16.3 million in the third quarter of 2023. Adjusted EBITDA was up 38% year over year, and free cash flow was up by almost 3x in a 1 year span. They had $98 million of free cash flow in the most recent quarter. Year ago quarter, they had $33 million of free cash flow. This company is hell-bent on making sure that they become way more profitable over the coming years. I think they know that their revenue growth is not going to be ridiculous. So that's not going to be the thing that attracts investors to the company. But more of a value-focused investor might be interested in Upwork stock because the company is very fairly valued right now. And they're committing to the fact that their net income growth and their adjusted EBITDA growth is going to be so much higher on a percentage basis than their revenue. They're becoming more and more profitable, and they're taking shares off the table to increase that EPS and increase total shareholder return. For anyone who doesn't know, Upwork is a massive freelancer network. They're trying to connect a freelancer with a large business or corporation. Anyone can go on Upwork and hire a freelancer, but they typically target larger corporations to be able to bring more and more revenue to the company. Speaking of revenue, they're only at 10% revenue growth, like I said. If the company is able to keep up their net income growth story, and they're able to bring more revenue in, let's say they go from 10% revenue and they accelerate that up to maybe 15 or 18% revenue growth, the stock is going to go ridiculous. This is attracting a lot of value investors right now because of what their focuses have been. They're saying we want to focus on net income, we want to focus on margins. That's going to attract a value investor. But if they can get a blend of value investors and growth investors because their revenue growth starts to accelerate again, the stock's going to go absolutely ridiculous. Okay, so for me right now, Upwork is still a buy. I am currently buying Upwork shares. I do have a pretty large position already. It's close to as big as I want it to be, but I am still picking up shares here and there because I think the company is very fairly valued. I don't think it's undervalued, but I think it's very fairly valued based on what I'm seeing from the management team, the revenue growth, the very respectable net income growth of 70%, the very respectable adjusted EBITDA growth of about 38%, and that share repurchase program makes me very excited to hold the shares right now and continue to pick up shares over the next few months. I really like the stock under 12. If it drops under 12, I buy much heavier. Above that, between roughly 12 and 15, I'll buy pretty light. Above 15, I'll still pick up a few shares, but it'll just be here and there, not major purchases or anything like that. Next stock up on the list is Vital Farms. This is ticker VITL. This is probably the most boring stock on the list because they sell eggs and they sell butter. That's pretty much it. That's all they really do. Very, very simple business model to wrap your head around. The market cap on this company is $1.32 billion. This is a stock that is down on a 1 month basis of about 25%. Down on a 6 month basis of 26%, but we're still up very nicely year to date at a 92% gain and a 1 year gain of 134%. My personal position is up about 95% on this company. It was up way more than that, but like we saw, we've had a little bit of a rough past month and a rough past 6 months. So the stock, when they reported earnings in this past quarter, got hammered. I do not think that drop was warranted whatsoever at all. I thought they had a great Q3, and we're going to go through some of those numbers here in just a second. Before we go through those numbers, I just want to talk about the valuation. So keep these valuation numbers in mind as we talk through the earnings that they reported. So they have a GAAP forward PE of 27. They have a GAAP trailing PE of 26. It's not great to see a forward PE higher than a trailing PE. Okay, so that might be what's frustrating investors right now. But when we look at the PEG ratio, this is price to earnings growth. A price to earnings growth below 1 is like pretty nice and impressive, especially if that company's got any kind of revenue growth that's substantial or any kind of net income growth that's substantial. But this company has a PEG ratio of 0.18. The stock is ridiculously undervalued. We are not taking future growth into account right now at the current valuation, in my personal opinion. And when we look at the PEG ratio, that confirms that. There is no valuation metric for Vital Farms that is like disgustingly overvalued. Pretty much every metric we look at, we can consider the stock to be fair value or undervalued. So let's chat about exactly what they reported. Third quarter net revenue of $145 million. That's up 31% versus the prior year period. How many food companies are out there growing their revenue by 31%? The answer is almost zero, okay? Just so you know, all right? They raised fiscal 24 guidance and they reiterated their long-term guidance, meaning they're on track to reach their $1 billion net revenue target in 2027. I love a company that has a public long-term growth outlook. We can track their progress based on their long-term growth outlook. It looks to me like they're going to absolutely crush their goal of reaching that $1 billion revenue in 2027. I think they'll hit it midway through 2026. I could be wrong, but I think they're going to absolutely smash that number. They've got revenue growing like crazy, and while they're doing that, they've got gross margin still expanding, and it's not expanding by a little bit, it's expanding by 368 basis points. That's 3.68%, very impressive gross margin expansion, all the way up to 36.9% compared to 33.2%. How many food companies out there have a 36.9% gross margin? The answer is almost none. Net income was up very nicely in the quarter, up to $7.4 million compared to $4.5 million in the year ago quarter. EPS was 16 cents in this quarter versus 10 cents in the year ago quarter. Also a very nice rise. Adjusted EBITDA was up to $15.2 million, all the way up from $9.3 million. Extremely impressive. They're running the business as good as you can ask for a butter and egg company. It's absolutely insane that they're able to grow revenue and continue to expand their gross margin and their net margin so impressively, and the stock got hammered whenever they reported earnings. I don't think it was warranted at all, but I think it gives investors another opportunity to pick up shares before the stock goes on another crazy run. They've got all this ridiculous growth while having one of the best balance sheets I've ever seen for a small cap company. Check it out right here. Cash equivalents, and marketable securities were $163 million at the end of Q3, and Vital Farms has no outstanding debt. What else can you ask for? We got crazy revenue growth, we got expanding gross margin, we got expanding net margin, we've got a bulletproof balance sheet with literally a 0% chance of bankruptcy, and we've got guidance being raised. Check out guidance here. In the interest of time, because I know this video is getting very long, I'm going to put their updated fiscal 24 guidance on the screen. Feel free to pause it and check out their specific guidance. For me right now, the stock is still a buy. It's not a massive buy, but I will pick up some shares here and there. And like I said, if I had no position, I would be buying heavy right now in order to make sure I can build my position before the stock starts to take off again. When you've got metrics like this company's got and fundamentals like this company's got, with the balance sheet they've got and the growth that they've got coming in the next few years, at least through 2027 per the management team, you got to pick up the stock and you got to hold the stock at least through 2027. This is a long-term hold for me. Very excited to be a shareholder, and I will continue to buy shares, but like I said, I'm not buying in a crazy way right now. Next stock up here is First Watch Restaurant Group. This is ticker FWRG. This is a restaurant company, obviously, and they're very unique in the sense that they only do breakfast, brunch, and lunch. They close at like 2 or 2:30 p.m. I can't remember off the top of my head, but they have no plans on opening for dinner whatsoever at all. They are the daytime diner, and that's the niche that they fill, and they have filled it very nicely. The average ticket price is a little bit higher than someone like Chipotle, but it's not crazy ridiculous. It's not like a premium restaurant or anything like that. It's a very respectable price in my opinion. In terms of the stock price, this stock has not fared as well as any of the other stocks on this list so far. In a 1-month span, it's only up 3%. It's down about 10% in the 6-month span. Year to date, down 12%. 1 year, down 1%. And all time, down 16%. So the stock has not performed great as a public company so far, but I think that's mainly due to inflationary pressures that were hurting the business for a while, and then that started to catch up to the consumer. So it hurt the business and it hurt the margins. That wasn't good for the stock. And then it hurt the consumer in a pretty big way, and that hasn't been good for the stock. They have same-store restaurant sales either flat or negative by a little bit. But they're in a massive growth phase. They're expanding like crazy, and they're opening new locations. They have a very lofty goal of reaching 2,200 locations. Right now, they have 574 locations. So when we're talking about total revenue growth is still expanding nicely because they're expanding their footprint like crazy. They're opening so many locations. And like I said, they have a goal of 2,200. Right now, they're at 547. There's a ton of growth to unlock inside of First Watch. They're going to go on a crazy expansion in terms of locations. Once they've done that crazy expansion in terms of locations, then they can do some crazy promotional material and a lot of marketing to get a ton of people in the door, and then they can worry about same store sales. I think it's important that they don't worry about same store sales right now, and they just kind of let it be what it is, which means they're going to be very subject to the macroeconomic environment for multiple years to go in the future. So if that's not something you're interested in, that's not a stock for you. But if you're okay with that and you're able to see the long-term growth from 547 restaurants all the way up to 2,200, and if you want to ride that growth story, once they get to a large amount of restaurants, like I said, then they focus on same-store sales growth. Then they focus heavily on margins. That's going to be a massive growth vector for them that they're going to be able to unlock once they've gotten their locations up in a massive way. This is a $1 billion market cap company, and I think we could see this hit a $4 billion market cap within the next 5 to 7 years, which would be a triple up. I know there's a lot of stocks out there that are flying to the moon right now, so a triple up in a 5 to 7 year span might not sound amazing, but if they're able to stay on their track of getting from 547 to 2,200 restaurants, and then worry about gross margin, then worry about net margin, then worry about same-store sales and increasing that marketing spend in order to get more foot traffic in the door, I think the company is going to be in a crazy good spot. If you're not interested in holding this stock for the next 5 to 7 years, I don't think it'll be a great returner for you. I think you're going to have to be a very long-term focused investor and a very patient investor in order to get a nice return with a company like First Watch. I personally hold shares of First Watch right now, and I'm continuing to buy First Watch shares. I'm not going to build this into a huge position in my portfolio. It's not going to be like an 8% weight. The max weight I would like First Watch to be in my portfolio is 5%. It is not to 5%. It's actually not even close to 5% of my portfolio yet, so I am still buying the stock. I think it's a very respectable buy, and this is a stock I'm going to be in for many, many years. I want to watch this story play out for the next 5 to 7 years. I'm not in this stock for the next 6 to 12 months, okay? Next company up here is Upstart. This is ticker UPST. This is an AI-focused loan originator, but at the end of the day, they're just a loan originator. Yes, they have AI in their name. Yes, they have their own specific model, and they use AI to empower their loan underwriting process. But let's be real, they are a loan underwriter. That's what Upstart is. This is my most speculative stock in my entire portfolio. It's not the smallest market cap. It has a market cap of $6.42 billion, which is actually a mid-cap company, but is the only company in my portfolio that is EPS negative right now. I did the math, and this is actually less than a 1% weight in my entire portfolio. This is not a stock I'm betting the farm on. This is a stock I bought all the way back in 2020. It was a bigger position then. The stock ran disgustingly high as $322 a share, and I sold well over half my position. I think like 70% of my position I sold, and I held the rest of it. And then over the next few years, the stock absolutely crashed to the floor, all the way back to my cost basis, basically. So my cost basis on the stock is $22.36. So we're up 214% right now on Upstart. I have no plans of buying Upstart stock, maybe ever again, but definitely not right now. It is absolutely a stock that is making investors a killing, but this is one of the highest beta companies I have ever seen in my life, meaning it moves more than the market pretty much all the time. And when it makes an upward move, holy cow, does it make a ridiculous upward move. 40% in a day I've seen. This stock is extremely volatile, and I would never build this position into a massive weight in my portfolio. It is a spec stock for me. I'm holding it because I believe this stock could go well into the 200s again, and if it does, I'll probably exit my position completely, but it's not like the revenue growth is insane or anything. They've got 20% revenue growth. The stock is still losing money. They've got a net income loss of $6.8 million. That's much lower than the year ago quarter of negative $40 million. The loss from operations is negative $45.2 million. The stock is not close to operating income positive. They are close to net income positive, and I would bet if they flip to net income positive for the next few quarters, we'll get another massive rise. And then a few quarters after that, I bet they would flip to operating income positive, and then another massive rise. That's what I think could move the stock up back into the 200s, given the fact that it's so insanely volatile. But for now, I'm holding my shares. Spec stock for me, not a buy right now. Then to cap this video off, I've got 3 stocks I just want to mention. SoFi has made investors 42% in the past 1 month, 113% in the past 6 months. The stock is going crazy. I think this was just a coiled spring. The stock was down for so long. People were down on their shares. Tons of people had massive positions that they were just waiting for it to take off. And I know for a fact, a lot of people lost faith in SoFi stock. I definitely did not lose faith. This is one of my largest positions in my entire portfolio. I've made many videos here on the channel, and check out any of them if you want to hear my commentary around SoFi. But I know that fundamentals reign supreme. And when the fundamentals are getting better and better and better each and every quarter, and the stock is not moving anywhere at all, we're just building up to a position where eventually the stock is going to rocket to the moon. And that's what we're seeing right now. Past 6 months, 113% gain. We're being spoiled as shareholders right now, but this wasn't without the wait. This wasn't without the pain of some people being down on their positions for months, if not years, with SoFi. So this recent move looks amazing, but you know what looked amazing for so long while the stock price didn't look amazing? The fundamentals, the net income growth, the revenue growth, the operating income growth, the member growth. Everything under the hood was looking amazing while the stock price was looking rough. Now everything under the hood is looking nice and the stock price is looking nice. So just remember, over time, stock price always agrees with fundamentals. It might not agree in the short term, and that's a situation where we can take advantage of some arbitrage. If we buy an asset that's fundamentals are amazing, but the stock price is not moving up, that's great. That means we can continue to build our position while the management team keeps going crazy, and we just wait for the market to agree with us that the fundamentals are in a great spot. That's what happened with SoFi. Congrats to any fellow SoFi shareholders out there. It's been an amazing 6 months, and I think we are just getting started. And I can't make a video about a stock making people millionaires without talking about Palantir. Palantir stock has been on an absolute tear lately. It's now the largest position in my entire portfolio in terms of dollar amount. We've made 266% year to date on Palantir and 541% in the past 5 years. This is definitely not a small cap anymore. When I was first buying the company, it was considered to be a mid cap, and it could have been included in this video, but now we're all the way up to $141 billion on the market cap for Palantir. The stock has gone crazy. It's now included in the S&P 500. They're trying to get included in the NASDAQ 100 by switching their listing from New York Stock Exchange to NASDAQ. Crazy story with Palantir. This is another situation where we were buying in the single-digit share price whenever the fundamentals were looking great and the stock price was not looking great. Now the fundamentals are looking great and the stock price is looking great. We're being rewarded in a massive way. Once again, congrats to any Palantir shareholders out there. Then the last stock up here is kind of an honorable mention. This is a stock I'm still in the process of doing research work on, but this is New Holdings, and that's ticker NU. First place I'm going to post my findings for New Holdings is actually going to be in the Patreon. I'm going to do my research work, and I'm going to put a report in there. What do I like about New? What do I not like about New? What do I need to see change? Am I going to pick up shares? I'm going to put all those details inside of there, what price I'd like to pick up shares, etc., and what percentage of my portfolio I'd like for New Holdings to be if I choose to open a position. I haven't decided to do so yet, but if I do, you will see it in the Patreon. So if you want to check out the Patreon with the link in the description, feel free to check it out. Join us in there. Join the other 33 or so members. We'd love to have you. Great community in there. All right, this was a beast of a video. I hope you enjoyed it. If you're still here at this point, make sure you drop a like and subscribe, and let me know in the comment section what smaller cap company, either a small cap or a mid cap, what company did I miss on this? What company out there is making investors millions of dollars or has the potential to do so? What small cap or mid cap stock do you see that's a double up, triple up, 4x opportunity, etc.? I want to hear about it in the comments below. I'm always looking into new stocks. So if you're looking at a stock out there that you think is really attractive, I would love to look at that stock as well. I love the community we've built here on the channel, and that really starts in the comments section. So if you feel compelled, drop a comment down there. Let us know if you hold any of these stocks, if you're interested in buying any of these stocks, or like I said, if there's any stock I missed on this list. I appreciate you being here in a major way. Thank you so much. Have an amazing day.